this is one thing that's quite interesting to actually conceptualize Ethena, maybe differently from the way that we positioned it as a synthetic dollar, which is you can actually just think about it as almost like an interest rate arbitrage vehicle between DeFi, CeFi, and TradFi, where you've got disparate interest rates, which often are like quite out of line by like up to 1,000 basis points at times. And it doesn't make a lot of sense where there are periods in the last few weeks that you could put down collateral on Maker, borrow at 6%, and then put it into Ethena at 60. Like that type of discrepancy makes like zero sense. And so really you can think of actually Ethena as just being a vehicle which forces these interest rates to converge. And the supply of USDe is just like the balancing icon that makes that all sort of come together.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic from 4RC. Today's show spotlights a recap of Ethena's launch since early February, which has led to this DeFi giant commanding $1.4 billion in total value lock. In this episode, we speak with Ethena founder Guy Young about what's made Ethena so successful right out of the gate, the impact of the Ethena Effect on DeFi, and what to know about their recent token launch. But before we do, just a quick word from our sponsors who make the Edge podcast possible. Introducing Flat Money, the first decentralized, delta-neutral flat coin built on Base with sustainable yield that's completely untethered from legacy finance. Because DeFi needs an uncensorable based unit of currency. You can mint unit with RETH, which is held in the protocol's shared liquidity pool, where it's borrowed by leveraged traders. As a leveraged trader, you can deposit your margin collateral and go long on RETH. If you're trading in the perpetual futures market, you'll pay unit holders to open leverage positions. If you're holding unit, you'll earn yield from liquidations, borrow rate, and trading fees. Preserve your purchasing power and offset your exposure to crypto market volatility. Learn more at flat.money.
Restaking summer is dawning, and SWELL is expanding. Harnessing the power of RSWETH, SWELL is building the Layer 2 for liquid restaking. That means native restaking yield on a chain built with Polygon's ZK EVM technology in collaboration with AltLayer, Chainlink, and EigenDA. Look out for SWELL's Layer 2 in Swell City.
Introducing the Mantle liquid staking protocol, Mantle LSP, a permissionless, non-custodial ETH liquid staking protocol deployed on Ethereum L1 and governed by Mantle. With Mantle LSP, users can stake ETH to instantly receive METH, earn yield and accumulate rewards the longer you stake. METH is the value accumulating receipt token that will give you access to expanded yield opportunities. Stake and watch your yield grow with Mantle LSP.
Introducing KELP DAO, the first liquid restaking platform for LSTs. With KELP, anyone can deposit Steth by Lido, ETHX by Stater, or SFRX ETH by Frax, and mint a liquid restaking token called RSWETH. With RSWETH, you can participate in your favorite DeFi platforms and get 100% of all EigenLayer points, plus KELP miles. A fresh wave of restaking is here, restaking that's liquid, rewarding, and convenient. Learn more today at kelpdao.xyz/restake.
It all started so simply with CryptoKitties and Maker on Ethereum, but quickly became complex with more applications and many chains. Today, everyone agrees UX issues are the biggest blocker standing in the way of crypto adoption. Introducing Avocado. Multi-chain UX redesigned from the ground up. The first wallet to abstract networks, accounts, and gas. One gas tank to pay transaction fees on all chains in USDC. And native access to INSTADAPP's powerful, custom DeFi strategies. Avocado, one wallet to rule all chains.
All right, let's introduce Guy Young, the founder of Ethena. Guy, welcome back to the Edge Podcast. How are you doing?
Good, man. Thanks for having me on.
Part of the reason we're here today is we really just want to have a catch up with you about what some are calling the Ethena Effect on DeFi. Would love to just kind of reflect on like probably the most epic launch we've seen in DeFi in a few years, And I know that we're also just looking to just better understand the mechanics of the protocol and kind of address some frequently asked questions that we're hearing from listeners and users. So on that note, Guy, maybe we should kick off then with just reflecting on the launch itself. Like, any thoughts you have on how it went, maybe like what made you so successful in that, and how that's propelled you to where you are now?
Yeah, I think from our perspective, we thought it went okay. There were like a lot of bits that we could have definitely done better. So I think myself especially and the rest of the team was just getting used to actually being publicly facing with the protocol. So it's very different when you're interfacing with like 100,000 people rather than 100, which is where we were when we last spoke. And a lot of like the communication that we put out, I think in the first couple of weeks, we could have definitely improved on in terms of how we're thinking about the insurance fund or like the yield payments, that kind of stuff. Otherwise, yeah, I think we also just need to recognize that the market conditions around like our launch were just incredibly favorable. So there's like a huge piece of luck that came into that as well, where I think when we had our first chat, funding was somewhere between 15 to 20%. And it obviously blew out to like 40 to 60 in sort of the weeks just immediately following the launch. So yeah, I think we recognize that obviously market conditions were very much in our favor for the launch itself. But yeah, reasonably happy with how it's sort of gone over the last few weeks. Maybe
we can also recap just some of the milestones. So I'm just reading off of the Ethena.fi website, but there's 1.4 billion I mentioned, which refers to the market cap here of SUSDE. Whoa, can't spell today. And then the yield based on the last 7-day average is 30.2%. It's been as high as 60 or 70% at times, which I definitely would give credit to. Like, that's been a driving force in terms of drawing more attention to Ethena and incentivizing folks to want to participate early. And then it looks like there's about 96,000 users. I'm guessing that's unique wallets that have interacted with Ethena. So I guess, like, what are your thoughts on that? Like, are you satisfied with this? Did this exceed your expectations?
Yeah, no, I think we're obviously happy with the outcome. I think there was a little bit of caution on our side because I think a lot of what we're doing was net new, i.e. we hadn't really actually seen a product like this scale and actually try and connect pieces of DeFi and CeFi in the same way that we had before. And so we just wanted to try and be a little bit cautious around it when we actually did the rollout of the product, because there's not only first order implications of like our effect on funding rates on CeFi, but actually like ripple effects that start to occur through the rest of DeFi. And so we just try to like do things in a controlled and slow way when we came out. But I've been happy that we sort of executed on that without sort of too many issues falling out. So yeah, I think from our perspective, very happy with how it went. I think the one piece that was actually quite surprising to me was actually like the willingness and openness of other DeFi applications which have been around for years and are like projects and teams that we at Ethena like look up to and have an enormous amount of respect for, like immediately being interested in what we're doing, and I think recognizing the opportunity that was there for them. So even just as one example, to see like MakerDAO come out, which has been traditionally like a project that hasn't done that's too much, that's sort of like on the cutting edge and new. They've traditionally been pretty conservative in the way that they approach things. To sort of see people like Rune come out and actually recognize the value that something like USDe could actually bring to Maker was pretty, I think, mind-boggling for us as a team to see that so early. And I think we've seen that across most of DeFi, whether it's Frax putting Ethena on its roadmap as well, Curve and a lot of the lending infrastructure that sits around Aave and some of the other money markets immediately engaging with SUSD, and then even some of the perp dexes who are now looking to use it as collateral to margin perps on their platforms. I think we've been just blown away by like the openness of DeFi to basically engage with the asset, and obviously that makes us pretty happy that there's other people who find that the product is interesting as we do.
Do you think you can explain the significance of MakerDAO raising the DAI savings rate? I guess, like, why is that? And I guess, like, how does that roll up into this thing I referred to as the Ethena effect?
Yeah, well, I think also maybe I'll just point out that I think Ethena might have had some impact on the margin on some of these pieces, but I think Ethena is not like the only reason that we saw some of those changes. I think that they were going to happen with or without Ethena actually being there. So I think the backstory on Maker in particular was that they'd held the DSR, which you can think of that as just basically the borrow rate on DAI within Maker, at 5%, when really like rates within DeFi across like Aave or other lending platforms had pushed beyond 10 to 15% or even above 20 for a few weeks. So like really Maker was trailing behind them quite a bit for a few weeks. And then I think once you start to see actually perp funding rates move to the numbers that you were mentioning at the beginning of the chat, when it's in the sort of 40 to 60% range, there's obviously a connection that actually occurs between DeFi and CeFi, where this is like, even aside from Ethena, you have some of the largest trading firms in the space just putting down collateral onto Aave, borrowing dollars, and then going and doing the cash and carry themselves. And so I think that change was going to occur regardless of whether Ethena was there or not. I think it's just that people made that connection a little bit easier between CeFi rates and DeFi. And I think actually this is one thing that's quite interesting to actually conceptualize Ethena maybe differently from the way that we positioned it as a synthetic dollar, which is you can actually just think about it as almost like an interest rate arbitrage vehicle between DeFi, CeFi, and TradFi, where you've got disparate interest rates, which often are like quite out of line by like up to 1,000 basis points at times. And it doesn't make a lot of sense where there are periods in the last few weeks that you could put down collateral on Maker, borrow at 6%, and then put it into Ethena at 60. Like that type of discrepancy makes like zero sense. And so really you can think of actually Ethena as just being a vehicle which forces these interest rates to converge. And the supply of USDe is just like the balancing item that makes that all sort of come together.
I think the market has firmly established that we're in a bull trend. What comes with that, of course, is funding rates that tend to pay out to shorts, and those have continued to grow. And that, of course, has been great for this tokenized basis trade that we can access through Ethena. I guess, like, what do you think in terms of, like, will these funding rates persist? I know that there's been a lot of modeling that was done before the protocol went live about, what happens when those rates go down. So yeah, what are your thoughts there in terms of like where we are and eventually when rates do come down, like how will that affect Ethena?
Yeah, I think maybe I could just speak at like a high level in terms of like structurally what might look different this cycle versus last cycle, because it's impossible for us to sort of say these interest rates are going to be here for X period of time. I think my general perspective on things is that there are very good reasons for why funding within the market is actually elevated and structurally higher than you've seen in the past. One example I can just give you here is actually if you think of all the CeFi entities that used to exist last cycle that blew up, so Celsius, BlockFi, and then some of the lending that you saw from Genesis, really like the flow of funds that was occurring there was they were taking in dollars from retail, paying out an interest rate to retail to provide dollars, and then actually lending that capital to hedge funds who are putting on the same sort of transaction that you're seeing with Ethena right now. Equally, you saw borrow lend platforms taking worse forms of collateral that isn't really accepted within the market now. So one example could be the GBTC type of cash and carries that you were seeing last cycle, where again, you're just missing a huge piece of the balance sheet of the crypto capital markets now, where all of those entities have disappeared and there isn't a supply of dollars that can actually come in to provide that short side liquidity. So there's really a huge piece of the market now that's actually missing to sit on the other side of that trade. And so when you see like the bullishness return to the market, as we have seen with the ETFs, there really isn't actually like that. There's like a dollar supply shortage within the market to actually address that. So that's like a big piece that's structurally different from last cycle, which is important to remember. I think the other piece to just think about is when BTC and ETH get larger through every cycle, they struggle to put on multiples in the same way that they did before. So as assets get bigger in their market caps, the realized volatility tends to fall. And so people within crypto, if you feel like you still need the same amount of like outright return that you saw as holding spot last cycle, you actually need to apply a little bit of leverage this cycle to sort of get the same sort of outcome on like a post-leverage beta. And so I think I've even seen that anecdotally, like myself, the way that I'm sort of like managing my own funds or even friends, is that ETH doesn't like move as much as it did last cycle, and you feel like you need to own it on a little bit of leverage with perps, which just has like this natural flow of sort of increasing rates in the system as well. So as like a broad bucket, I think that there's a couple of good reasons for why you've actually seen funding elevated. And actually it's quite, just taking one step back, it's actually quite rational to see funding rates at these levels if you actually believe that the underlying asset is going to move as much as it has sort of moved with the ETF news at the moment. So People were paying like 50, 60, 70% funding on BTC in Q4 of last year, but Bitcoin doubled going into the ETF. And so like that was actually a rational trade to make because you had such a strong view on how the underlying was going to move. And so we just have like such strong bullish news that's coming around ETFs that actually like high interest rates can actually be rationalized if you have that sort of directional view to get long. So I think maybe just circling back to like the original question, which is like, how do we actually respond when that does subside? Because obviously it's not going to continue like forever. I think structurally there tends to be a spread of like perp funding versus borrow rates in the rest of DeFi. And so historically, even through the bear markets, you are still earning more in CeFi than you are in DeFi when things do collapse. And so there's always this natural spread where even if we do go down, the competition and sort of the hurdle rates of returns tend to sort of track down at the same rate. And then the other thing to just remember is that actually, like as I was alluding to earlier, the supply of USDe is really just responding to like market forces. If interest rates go down and people don't want to hold the product at a lower interest rate, that's fine. They're going to sell out of the product and go into something else, which has that like natural effect of sort of lifting short interest and allowing the funding to revert. And so our like philosophical view on these things is that the market forces are the market forces. You never want to step in front of them. And all we have to do is put the infrastructure in place so that we can respond to like those interest rates. And if there's a lower demand, then USDe will fall. And there's nothing that we can sort of do to stand in front of that.
Before we talk about the Shard campaign, Pendle, and the future token, there's a few concerns or frequently asked questions that we identified from users that I'd love to have you just quickly address. So these are kind of like rapid fire responses. One of those was, I can do the trade myself. I guess, how do you respond to folks who say, I can do this delta neutral trade myself?
Yeah, the answer is you can do it yourself. And there's nothing stopping you from actually doing it. I think what people forget is that actually doing it yourself or the trade is not actually what's interesting about Ethena at all. Like anyone can do it. What is actually interesting is that when you tokenize that into an instrument that can actually then compose with the rest of DeFi, that's when you start to unlock all of like the magical things that like you can't do if you're just doing it on your side. So like some of the largest holders who are sitting in USDe now are some of the most professional trading funds in the space who are actually probably doing the cash and carry even better than Ethena is doing. But the magic really starts to happen when you can take that asset with SUSDE, you can put it onto Aave, then you can borrow dollars against it, you can lever it up, you can put it into an AMM, you can like pair it with SDI, all of these different things that are not possible when you're just doing this on your own account sitting on a SEX. And then I think a huge unlock as well, which is going to be like a pretty big piece for us going forward, is actually just thinking about SUSD as margin collateral on centralized exchanges and indexes as well, where there's around $20 billion of tethered demand where the only demand is actually just to margin a linear perpetual. And so for us, or at least for trading firms who are actually focused on capital efficiency, like granting them an ability to actually extract 10, 20, north of that % yield on the collateral that they're actually using to trade is like a really big deal actually for them in terms of like lost income that they would have otherwise. And so we see that as like a huge growth area where, again, they could be doing this trade themselves, but it's actually like more interesting for them when you build liquidity around a single token. I think the good example here to actually point towards is thinking about Lido, where I could ask the same question and say, you can stake yourself, can't you? And the answer is yes, you can go and sell the stake, but guess what? Everyone's decided to put it into Lido because you can do all these interesting things with it afterwards. So I think that's like a reasonable analogy to draw.
Well said. Yeah, that's what drew me in originally. It's the composability, and whether or not you could do that trade yourself. I wouldn't count myself in that group. Being able to use that and all the different DeFi opportunities is where the real value's at there. Another concern that came up is I recall, like, as we were talking in the last podcast and as you were launching, there was more of a framing of USDe as a synthetic dollar. I guess, like, how do you think about that since launch? I feel like the language that we saw was more around a tokenized basis trade. So what are your thoughts on that? Is USDe still capable of becoming a synthetic stable coin, or should we refer to it as this tokenized basis trade?
Yeah, I think the honest answer is like people can call it whatever they want. I think the onus is on us though to make sure that we're being clear that it is basically not the same as like a fiat stable coin, which is like, that's really what I'm focused on, which is making sure that people understand that the risks are very different. It's not to say something's better or worse. It's just that actually it's different. I think we were quite surprised, I think, on the pushback around that piece in particular, because we'd actually been pretty explicit around that, both in the documentation and the way that we were actually speaking on Twitter, where even on like the fundraising announcement, we said it like super clear and actually pointed towards the documentation to outline that even further. And so I think from my perspective, it's quite difficult because actually there's a pretty large design space within stablecoins or like dollar-denominated assets broadly, where actually, you've got CDPs that look very different to delta neutral designs that look very different to fiat stablecoins, and like all the flavors of different things that we've seen in the past. And we haven't actually really come together as like an industry to say, this is how we should define them and how we should actually like put some parameters around it. So I have pretty clear views on my side around what a stablecoin should look like, and it's pretty boring. It basically looks like PayPal's PYUSD, and everything else is like a bit murkier beyond that. I think from our perspective, we were just quite surprised because you'd seen projects in the past who are doing the exact same thing as Ethena on chain, like USDe and Lemma. They called themselves stablecoins. Like their investors were writing like long shilling pieces, like talking about them as stablecoins, and no one said a word back then. And it seemed to like really trigger people like when we came out, which I think was slightly surprising. So from our perspective, I think we've done what we need to on our side to try and make it clear to users that the risks are very different. And if people want to call it a cash and carry or a synthetic dollar, whatever they want to call it, we can't really control that. I think we just need to make the risk clear on our side.
Yeah, I think there's some PTSD from Terra and UST. And so when folks first see that 20 to 30% yield, and really it's been much higher than that for most of the time you've been launched since early February, you start to wonder, where does that yield come from? So I almost feel like it's a sign of our markets, despite the stupidity that goes on in a bull run. It seems like folks have gotten a bit smarter in terms of continually questioning, okay, like how does this thing work? And then you discover like, wow, the yield is real here. And like, has this always existed? There's so many folks who just didn't realize the opportunity was there. And now, of course, with the timing, I think everything you mentioned with the market structure and some of the things that are a bit different with lots of perps available on chain now, lots more folks, I think, participating in perps trading and that having an effect on driving rates up. It's all been like the perfect storm for really an exciting time. One last concern or question that's come up is there is an insurance fund. How does it work? Do you think it's sufficient for now? Also, too, like maybe you could clarify. My understanding has been that all of the yield hasn't always been paid out since launch. Some of that has been trimmed to build up this insurance fund. So that's exciting. If I'm correct about that, it's exciting to know that you've been able to trim some of that and build up the insurance fund.
Yeah, I think at a very basic level, what we're trying to do there is basically just have a pool of capital that sits there to potentially pay for periods of negative funding. So the very basic way to think about this is like, in the good times, things are so excessive that yield looks crazy, and like people don't even need to get paid 60% to sit in something. It's like 20 is pretty good actually, like return on dollars. And you get like these large periods where the return is so excessive that doesn't make sense to basically just trim a bit off during the times that are so good and leave something there for like a rainy day when things are not as great. I think one thing to just point out around the product is that there is frictional costs for people coming like in and out the whole time. So there's obviously transaction costs that occur to execute the hedges and sort of unwind positions as well. And so you want the supply to actually adjust to interest rates, but you don't want it to be going like absolutely crazy, because that's also just not like a great user experience, which is like you're coming in one day, it's at like 40, and then it's like -10 another day, and you just don't feel comfortable sort of sitting there. And so all we're trying to do is really just take a bit off during the good times and leave some there for the bad times. It doesn't mean that we're trying to fix to like an artificial interest rate that we're like just plowing VC money into like you saw with Anchor. It's just really there for the moments where things are like low. You've got a bit of a pot of money there to sort of give users a bit of peace of mind. We feel pretty comfortable with the size of where it's at now. It's been accumulating like pretty quickly. So you might have seen some of the data and graphs that were coming out from Token Terminal, but like within even 3 weeks of our launch, Ethena was like the highest fee generating app in the whole of crypto. Obviously, when the rates are that crazy, that's going to be a natural outcome of that, and we can't like expect that continues always. But like in the period like this, even at small supplies of like $1 billion, it's still producing that much cash that you can sort of capture to that insurance fund. And so, yeah, I think from our perspective, we feel pretty comfortable about where it's sitting at the moment. And I think going forward, there's a few different levers when we do sort of decentralize with the token to actually think about how we might sort of further capitalize that going down the road.
So part of the launch has been this Shard campaign, and I would just replace Shard with maybe points if folks aren't familiar with that. Can you summarize just like how the Shard campaign was designed, like how it's gone? And then I'd love to, of course, talk about the impact of Pendle on the Shard campaign.
Yeah, I think the basic design here was that actually what I was getting to earlier about the composability of USDe being like what we actually find interesting about this. We just wanted to try and use an incentive to actually get people to take the asset rather than just like buy $1 and sit there and, do absolutely nothing with it. Actually take it and start to plug it into different applications. It's also quite useful from like a BD perspective, which is if users are excited about our airdrop and the shards and all that kind of stuff, it sort of pushes other applications in DeFi which haven't got the incentive sort of card to play at the moment to actually be engaging with us and actually listing the asset and doing new and interesting things. And so we just found it like it was a really good mechanism to, not only get users using the asset and actually being productive with it in DeFi and actually taking it to new applications, but actually quite helpful for us to like bridge relationships to new protocols and say like, we can bring you some TVL with users and excitement and all that kind of stuff. Like, how can we find a way to work together? And so it was pretty incredible, I think, just in terms of the doors that it opened to actually doing new and interesting things with whether it's like L2, so looking at native yield within their bridges, or with the money market, and then obviously the DEXs as well. So that was really the core intention, which is you get users who are like early believers in the product to use it and actually not just hold it and do nothing with it, but then also start to like bridge relationships to other projects where we wanted to sort of build longer term relationships with.
What are your thoughts on the Pendle integration? So if folks are unfamiliar, Pendle has been this hub of speculation around future token launches. It has allowed us to buy these yield tokens, which in the case of Ethena, you have a claim on all of the shards that are accrued. So like essentially, if I were to buy, let's say like 10 YT tokens, I'm speculating on a much larger value than if I were to like put my own like money to work in there. If I were to put, let's say like 100 USDe into Ethena or mint 100 USDe. Actually, it's not that. I want to clarify. We're not minting them. We're swapping and buying those. So let's pretend I'm holding 100 USDe. I actually could go and buy these YT tokens, and I'm farming with much larger amounts. This has been replicated by lots of other LRT protocols. I think it was actually started with EtherFi. It looks like it's just had an enormous impact. Like that Shard campaign, that pool of Pendle users looks like it's always at the limit, whatever the cap is on that. I guess, like, what are your thoughts on this? Like, can this opportunity persist after the Shard campaign completes, after the token generation event? Maybe what can we look forward to there in the coming months?
Yeah, I think probably just want to open up by saying, like, we as a team and me individually, I have an enormous amount of respect for like Pendle as just like a project. Like, I think they're probably the best example during this last bear cycle of like something that was basically like forgotten and left to the wayside, and like they just continued building through the bear. And like you've obviously seen that chart, looks like this ridiculous sort of hockey stick that came back. So I think they're actually like a really good example to everyone, which is like continue pushing until you find product market fit, and then that's sort of the reward that you find on the other side. Yeah, I think the project is super interesting. Like at a very basic level, all you're doing is exchanging someone who wants to speculate on what that airdrop would be for like another user who wants to just lock in a fixed return. The slightly crazy thing about this is that it's probably the most degenerate thing you can be doing in the market outside of like Solana shitters at like $1 million market cap, because it's a multivariate like equation which you have no information on. So you don't know what the FDV of the project's going to be, you don't know what the supply is going to be, and you don't know how long the campaign's going to run. So like there's three important variables which you don't like have any information around. You can only sort of like put like try and benchmark around it. But then it also means that like when you have so much uncertainty and unknown items, it also means that people can misprice it pretty dramatically. So you did actually see that a little bit with the Ethena pools, where when we came out, we accounted for like north of 80% of all trading volume on Pendle, and it was like the largest trading day they'd ever had when USDe came out. And people were looking at it because the yield got up to like almost 200% on USDe fixed for like a month out, which is slightly insane that you get like a guaranteed 10% return like in a month's time. The interesting bit there was that like, because that's optically so high, people are looking at that and going, surely I have to be taking this. But then I think when you run the maths of like, because the duration was so short, it could have still made sense for like YT buyers on the other side. So it's just like this really interesting game. People like speculating, and like I think the unspoken thing is that actually YT buyers in a way are sort of getting like early access to the token before it's actually live, and like we can have a longer conversation around potentially like some unhealthy dynamics that you're seeing in the market with like every token just coming out at like $15-20 million straight out the gate, and like no one really having access to sort of like see the upside in that. Pendle is like this interesting sort of way that I think people are trying to get quasi exposure to the token as well. I think beyond like the token incentives, actually, the Ethena and Pendle matchup is probably one of the most interesting products you're going to see in the next year. So put aside all of the points farming, all of the shards and all of that stuff, and just like assume it's like a temporary thing. The idea of basically taking staked ETH and the basis into SUSDE and then actually selling the yield forward at different maturities, what that is actually doing is creating like the first scalable crypto native like yield curve in crypto, because you can now actually hedge out forward in time your staked ETH returns and then also the funding going forward. So you might actually be like a trading fund who's like long a ton of perps, and you actually want to hedge out that risk and actually like lock in your perp funding by sort of like selling that to someone on the other side within Pendle. And this starts to create like really interesting interest rate markets that we haven't actually seen at any material scale within DeFi before. Part of the issue why you didn't see that before was that the markets were too small. Like you'd build like interest rate swaps and stuff around a small little RBER market or like a strange like Uniswap V3 position, but none of these were like single scalable instruments that you could actually just build infrastructure around. And if you believe that SUSD can get, you know, multiple billions and there's like real amounts of yield that you can actually be trading around that, this becomes like really the first time that you can start to build all of those interesting interest rate swap type products. So aside from the shard type stuff, that's probably one of the more interesting pieces to me about Pendle. And I think like often it's sort of portrayed as this like points casino on the outside, but I think if you dig like one layer deeper, there's actually something a lot more interesting going on beneath the hood, which is like unlocking speculation on rates and yields, which is like a huge market in the real world.
It is a great example of bringing together two very different players in the market and having that work in a very symbiotic way. I want to point out like the YT holders that you mentioned, like those folks are clearly the more degenerate speculators, and that includes myself, and folks that are, you know, whether it was Ethena or a lot of the LRT protocols. What was really unique too with Ethena is the fact that we had seen the opportunity play out with LRTs. And so you had folks that were buying the PT token, the principal token, which is essentially a discounted version of an LRT like ETH or PuffETH or whatever. And then that matures to full value. And then, of course, you've like earned this, you know, pretty substantial yield. I think like they've on average been like 20 to 50% APY. And so with Ethena, it was exciting to see this work with stable coins, knowing that, hey, like I can get into this without having to lock in a fixed rate with something that's more volatile like ETH. So I would imagine this is one of many. This is one of the first examples, but there will be many, you know, after this. Any final thoughts on the Shard campaign in terms of, like, are there plans to continue the Shard campaign after the TGE? Anything you can share in advance?
Yeah, I think when listeners are listening to this, when it drops, the information will be out in the public. But yeah, the idea is actually post-TGE, we're going to be running a second campaign that looks pretty similar. We're going to be introducing it's going to be really like focused on like the new product launches that we're coming out with. So Bitcoin has actually just been added to Ethena as like a collateral asset, which is a pretty huge piece for us to actually scale this to like beyond $10 billion in size. And that's like an exciting piece that we're really glad that we can bring to market straight away. And then there were just a few pieces with how quickly the first campaign went. There were like a bunch of different things that we wanted to do and didn't get time to do because it sort of ended so quickly by us sort of getting to $1 billion. in just over a month. So that's integrations with different PEP dexes to actually get SUSD as collateral there. There's different L2s who are focused on yield, where we're going to be doing some large campaigns. And then all of the stuff that you've seen around Maker and Frax, we really want to like put a focus into making sure that that goes well, because there's a huge opportunities that can sort of like really move the needle at size for us.
You're confirming then that Ethena will run this basis trade for Bitcoin as well?
Yes, it's live as of yesterday. Yeah.
Wow, that's exciting. Cool. Yeah, I think we'll have this out in the next few days, so it could be announced by then. But yeah, just learning that live here on the podcast, had no idea that was coming. Speculated that was coming. Guy, do you think Ethena will ever run the basis trade with one of the LRTs? Like, obviously this can be used with other assets, and I absolutely understand why you would prioritize Bitcoin next. It is the most liquid crypto asset and it has the largest market.
Yeah, I think it's obviously an area that we need to put some thought into, because it's obviously going to be a big and important piece of the market going forward. The problem here is just one around like liquidity and actually getting that down as collateral. So it was actually quite a big effort to actually even get exchanges to think about staked ETH, and that was like a multi-year process with them building like hundreds of millions of dollars of liquidity on chain before that even became like a real question. Part of like the issue that I have, or like concern at least, is that the LRT market I think is going to be a lot more fragmented than you saw with LSTs, where you really had Lido as a dominant player there, where you could actually focus liquidity around. And as a result of that, the more and more LRTs that you see, the less and less likely it actually becomes that like we can focus on one of them, build liquidity around it, and then use it as collateral in new and interesting ways. Having said that, and then I would also just say, like, philosophically, we want to keep USD pretty much as simple and safe as possible. Like, there's obviously a bunch of different financial risks sitting around it, and like adding more like risks that sit around LRTs, the trade-off, like, it starts to not make sense unless you think you can do it at like $5-10 billion at size, just relative to where we are and the opportunity that sits there with just ETH and BTC and potentially Solana as well. And so I think our perspective is we're looking at doing things that might be separate side products that sit outside of USD itself. So you can actually try set up vaults essentially where you can put in dollars, which we then in the back end convert into something like DeFi's liquid restaking token, and then use that in the background with like some of the extra collateral that sits there to potentially put on a hedge, which is like locked for a period of time. This is just something that we're like ideating with at the moment. We're going to like put it out for like community feedback at some point in time. And we haven't made like any strong decisions around how we do that. But I think the team's perspective at least is that you want to keep the risk of LRTs outside of the core product itself for the moment, because we just want to keep that as safe and secure as possible.
Hey, can you remind us which chains is USDe available on now? I know ETH mainnet, any other like L2s or L1s, and then can you share where Ethena might prioritize launching USDe next?
Yeah, so we're on ETH1. We announced we're using layer 0 FT to actually just transport USD to different chains pretty seamlessly, and that's using Axelar as one of the DVNs as well. The idea there is we're going to be doing a pretty strong push into Mantle, who I know you've had on the show a couple of times, and we've sort of discussed the partnerships that we have there. There's Manta, Circuit, and a few of the newer chains who are coming out with a focus on yield, and they're going to be using USD within their infrastructure to try and support like dollar-denominated yield. And then I think when the time's right, there's obviously just a natural interest to be on some of the bigger layer 2s, like Arbitrum and Optimism. And once we get around to the Solana collateral, that actually sits within Ethena. So I think after adding Bitcoin collateral, Solana now is actually the size where it makes sense for us to devote some resources to it. I think that would look to expand to Solana as well.
Guy, if anyone's been listening to the podcast up until now, they've got to be wondering about the future token. So what can you tell us about the Ethena token, and when will it be generated?
Yeah, I think by the time people are listening to the show, we'll have something out which just has a bit of the details around the governance token. So that's going to be launching on the 2nd of April. The idea here is that there's obviously quite a bit of decision-making that actually you'd want to decentralize within the system. So a lot of the commentary that you've seen on Twitter around the composition of the insurance fund, how much is actually going into the insurance fund, how we think about the collateral backing between different LSTs, different products like LRTs that you're describing, composition with Bitcoin versus Ethereum, all these different things these are actually things that we sort of want to leverage the community's input to actually sort of help support manage as well. So yeah, the idea is that we'll come out with a token. We're going to be doing the second season of the incentives that I mentioned alongside that. And yeah, there's, I think, really interesting ways that the token can actually get involved with the governance decision-making within Ethena going forward. And then, yeah, in terms of like plans after that, I think we sort of touched on the main ones, but really from our perspective, it's like continuing doing more of the same to just like grow the scale. So at the moment, we're around 14% of all ETH open interest globally, like within Ethena. I think when you start to get to like 30 to 40%, you start to like push up to boundaries which are like have some constraints around the product itself. And so we're just basically going to be opening up capacity with new collateral assets like Bitcoin and then eventually Solana, and then bringing USDe to different chains and different applications where really in the first season of the incentives, it was like the first step. So like trying to get onto Aave, integrating with Maker, Morpho, all those different types of things. It was really like a first step that was made, and now the second one is going to be like really pushing the adoption and like expansion of USDe into these different applications.
Guy, this is a good place for us to wrap up. And wow, like congrats on the upcoming token launch. So I did not realize it was that soon. So by the time folks listen to this, I would imagine the token will already be out. If they want to learn more about Ethena, I would recommend going to Ethena.fi. That's their website. Be careful because there's lots of phishing links on Twitter. So type that in and bookmark it. And then be sure that you follow the Ethena account at Ethena_labs. So you can find that on Twitter and in our show notes. And then leptocurtic _ is Guy's personal Twitter account, which I would also recommend following. So Guy, thanks so much for coming on short notice to talk with us about just all the great updates here, and again, just congrats on like all the success so far. I know we're not anywhere near the end game of Ethena, but it's been an exciting launch for the last month or so. That said, can you close us out with anything else around like what's next for Ethena? You alluded to season 2 coming. I guess like any recommendations for folks that want to get involved with Ethena or participate in the season 2 of the Shards campaign?
Yeah, I think if you've been involved in the first season, there's going to be incentives for basically like loyalty and like sticking around as a protocol. So there's going to be like added incentives and rewards for having just been part of it and sort of continuing. It's going to be much of the same of what we saw and just try to drive adoption and integrations into different areas of DeFi and then actually eventually CeFi as well. And so, yeah, if you haven't actually engaged with Ethena yet, we just ask that you sort of review the risk documentation, and we've outlined in pretty good detail, I think, like how this looks different to different stable-like products in the market. And so if you just review that, and then you can engage with us on Discord as well, and we'd absolutely love to have you within the second season that we're running.
Thanks everyone for tuning in. If you're a talented founder or developer, please consider reaching out to our team at fourthrevolution.capital. And for future episodes of the Edge podcast, please check out our link tree at edge_pod.